Did you know that a single technology stock surged over 2,000% in a year, collapsed by 45% in just 4 weeks, and then left retail panic sellers in absolute ruin while the smart money quietly executed a multi-billion-dollar masterclass in market timing? Today, we are breaking down Sandisk, ticker SNDK, just hours before a critical fourth-quarter earnings release that could trigger either a massive short squeeze or a devastating earnings crash across the entire semiconductor industry. Whether you are a short-term swing trader hunting rapid gains or a long-term investor searching for the ultimate AI hardware moat, you cannot afford to miss what we are revealing today. Here is what is coming. We are going to dissect the anatomy of a 45% sell-off that created a once-in-a-decade entry point, show you how our predictions mapped flawlessly to real market action, unpack a $42 billion contractual shield that Wall Street is completely ignoring, and reveal exactly why the options market is pricing in a $186 swing tonight. But while these headline numbers look absolutely incredible, there is one hidden multi-billion-dollar metric buried in the balance sheet that changes everything about how you should value this company. If this kind of institutional-grade analysis helps you make better decisions, take 1 second right now to hit that like button and subscribe so you never miss a breakdown like this. First, let us rewind and understand how this incredible tactical setup was built in the first place. The massive sell-off we saw in July was not a death knell, it was a generational buying opportunity. For weeks, the financial media was screaming that the AI memory boom was dead, driving the stock down 47% before today's earnings call. But our tactical setup on July 30th successfully called the technical bottom of this panic. The core thesis is simple. SNDK has been trading at a forward price-to-earnings multiple of just 5.7 to 6.9 times its fiscal 2027 consensus earnings. The market completely ignored the fact that Sandisk is no longer a cyclical chip maker. It has transitioned into a hyper-growth AI hardware giant whose margins are legally insulated by binding multi-year supply partnerships. Tonight's fourth-quarter earnings and the upcoming Investor Day on August 13th represent the definitive shift from a volatile pricing story to a high-visibility contractual moat. But could this be the last time we ever see SNDK trading at single-digit multiples? Could the market be making a once-in-a-generation mispricing error right now? Let us compare our predictions directly to the actual market reality and find out. Let us look at the scoreboard, because the July 30th predictions mapped flawlessly to what actually happened in the market. First, we identified the optimal tactical buy zone between $1,000 and $1,100, anticipating that the psychological $1,000 level would be fiercely defended by a massive institutional put wall at $840. What happened? The stock capitulated to an intraday low of $998.19 on July 29th, before dip buyers rushed in to force a close at $1,015.89. Second, we predicted that once the squeeze ignited, our near-term tactical exit target sat in the resistance zone between $1,310 and $1,482. On Tuesday, August 4th, the stock surged to an intraday high of $1,446.62, closing at $1,427.62, landing smack in the middle of our target exit zone. Finally, we noted that SNDK would reclaim its normal baseline channel of $1,400 to $1,600 prior to earnings, which it did by breaking back through its 100-day moving average. This is as perfect as technical analysis gets. But what if this level of precision is not a coincidence? What if the institutional playbook is even more predictable than anyone realizes? To understand the forces at work, we need to visualize the sheer speed of this recovery. If we look closer at the actual price chart, you can see the anatomy of a perfectly executed technical rebound. The stock hit rock bottom, testing the exact lower bound of our institutional defense zone before exploding upward. The fuse was officially lit on July 30th, when a massive 26% single-session surge blasted the stock back to $1,279.96. This single session wiped out millions of dollars in short positions and proved that the demand for AI hardware is far stronger than the bears want you to believe. But a move this violent does not happen in a vacuum. It requires a perfect storm of macroeconomic tailwinds and product breakthroughs. So, what were the major fundamental catalysts that supercharged this technical squeeze? The momentum started on July 30th, when Microsoft confirmed a massive 43% Azure cloud growth rate, demonstrating that big tech is not slowing down its AI infrastructure spend. On the exact same day, memory giant Samsung posted an 1,800% profit surge and warned that server memory supply shortages would persist through 2028. This squeezed shorts immediately. Now, we did face a minor bump on July 31st when Kioxia missed its quarterly earnings consensus, causing a temporary 4.8% dip to $1,214.83 as the market briefly panicked about NAND pricing cooling. But then came the hammer blow on August 4th. Sandisk and SK Hynix jointly released the first Open Compute Project standard specification for high-bandwidth flash, or HBF. This officially validated the concept of substituting flash memory for expensive DRAM in AI inference servers, driving an aggressive wave of speculative buying that rocketed the stock up 11% in a single day. Could this new HBF standard completely redefine the memory hierarchy in every data center on the planet? Could we be witnessing the birth of an entirely new product category worth hundreds of billions? Now, while these macro catalysts explain the short-term price action, they are built on a financial foundation that is incredibly strong. We have established that the tactical rebound was executed flawlessly. But as a long-term investor, you cannot live on technical charts alone. You need fundamental truth, and the fundamental math makes SNDK a generational strong buy. We are talking about a business that has structurally rewritten its operating model while the market was looking the other way. To prove this, we have gathered all the latest news, fundamental metrics, and institutional updates from our sources. What we found is a combination of financial strength, contractual safety, options dynamics, and valuation disconnects that we have rarely seen in the history of the semiconductor sector. Let us break down the 4 pillars of this strong buy thesis, starting with a balance sheet that looks more like an absolute fortress. Sandisk possesses one of the most bulletproof financial profiles in the entire technology sector. Let us start with debt. The company has zero long-term debt. They have completely wiped it out, giving them maximum financial flexibility. On top of that, they are sitting on $3.7 billion in cold hard cash on their balance sheet, operating with a pristine current ratio of 4.8. But the real jaw-dropper is their profitability. Last quarter, non-GAAP gross margin exploded to 78.4%, sequentially crushing the low 50s and smashing management's initial guidance of 65 to 67%. This incredible margin profile yielded sequential data center revenue growth of 233%, reaching $1.47 billion. The business is literally printing money right now. But many investors are still terrified that these massive margins will collapse when the chip cycle inevitably turns. What if those fears are completely unfounded? What if Sandisk has engineered a permanent escape from cyclicality? This brings us to pillar number 2. The historical market fear with memory chip stocks is spot market cyclicality and sudden pricing crashes. But Sandisk has engineered a structural pivot called the New Business Model, or NBM. They have legally locked in 5 multi-year supply partnerships, yielding over $42 billion in minimum revenues. And here is the kicker. These agreements are backed by over $11 billion in hard, non-refundable customer guarantees. This contractual shield mathematically insulates Sandisk's 78% plus gross margins from spot market crashes. The volatility is gone, but the high margins are here to stay. This is a complete paradigm shift that the market is still pricing like a traditional, volatile, cyclical commodity business. What if the market never fully reprices this transition and you could accumulate shares at these compressed multiples for months? That would be extraordinary. Now, none of this matters in the short term if the underlying mechanics of the stock are broken. So let us look at the options market because the underlying mechanics of SNDK remain an absolute powder keg. First, short interest recently spiked 9.17% to 7.86 million shares, representing over 5% of the public float. This means a massive herd of short sellers is trapped at the bottom, primed for a devastating short squeeze. Second, institutional options flow confirmed a massive $57 million risk reversal, with smart money aggressively selling $840 puts to fund highly leveraged call options at $1,520 expiring this Friday. This institutional options flow acts as an ironclad floor under the stock. Finally, implied volatility has surged to a massive 129.7%, placing it in the 92nd percentile. The options market is pricing in a post-earnings move of plus or minus 13% tonight, which translates to a massive $186 swing in the share price. Could every single trap short be forced to cover simultaneously tonight, creating a cascading squeeze of historic proportions? So, with the short squeeze primed and the business contractually protected, What is this stock actually worth? This is where the valuation disconnect becomes laughably cheap. Trading at single-digit forward multiples for a hyper-growth AI giant is an extreme market anomaly. SNDK currently trades at a forward price-to-earnings of only 5.7 to 6.9 times its fiscal 2027 consensus earnings. Let that sink in. A company that is generating $2.99 billion in quarterly free cash flow is trading at a multiple normally reserved for dying brick-and-mortar retailers. Meanwhile, peers like Micron trade closer to 10 times forward earnings. If Sandisk simply re-rates to match its peer average, the stock would surge instantly. This is a massive disconnect, and Wall Street is finally starting to wake up to it. You do not have to take my word for it. Let us look at where the major investment banks are setting their targets. Wall Street has fundamentally doubled down on SNDK despite the recent market volatility, and there are 0 sell ratings on the board. James Schneider at Goldman Sachs has a price target of $2,200. Bank of America has set their target at $2,500. Mark Newman at Bernstein is aiming for $3,000. And Mehdi Hosseini at Susquehanna, despite a minor cautious trim, has a target of $3,050, representing a staggering 115% potential upside from current levels. The consensus average target lands between $2,376 and $2,433, pointing to an average implied upside of 70% over the next 12 months. The street high target sits at $3,169, suggesting over 124% upside. When the smartest minds on Wall Street are this unanimously bullish with 0 sell ratings, it is time to pay attention. So what are the immediate events that will force the market to recognize this massive undervalued moat? We have 2 imminent high-stakes catalysts that will act as the ultimate handoff test for this stock. The first is tonight's fourth quarter fiscal 2026 earnings call at 4:30 p.m. Eastern. This call is expected to confirm the massive cash generation power of NAND and officially mark the transition away from a cyclical pricing story to a contracted AI growth narrative. The second major catalyst is the Institutional Investor Day on August 13th. This is where management is expected to detail their highly anticipated fiscal 2027 guidance and prove to the world that their 80% margins are structurally locked in multi-year contracts. These 2 events will force institutional investors to stop treating Sandisk like a commodity play and start valuing it as a premium AI leader. What if both catalysts deliver above expectations simultaneously? Could we see a re-rating event that compresses years of upside into a matter of days? With these massive events just around the corner, let us talk about the exact game plan you should execute right now. We need to tailor our strategy to your specific time horizon and risk profile. For short-term swing traders who successfully bought the dip in our tactical zone between $1,000 and $1,100, you are already sitting on spectacular 40% plus gains in less than a week. Because tonight's earnings carry an extreme implied move of plus or minus 13%, the most disciplined tactic is to scale out of profits near the top of our exit zone between $1,420 and $1,450 ahead of the binary event. Lock in those massive gains and let the remainder ride with tight trailing stop losses. However, for long-term buy-and-hold investors, our recommendation is an aggressive strong buy. You must ignore the short-term noise. Utilize any post-earnings volatility to aggressively acquire shares ahead of the August 13th Investor Day. Because if you have a multi-year horizon, the long-term projection for this stock is absolutely staggering. If we look at advanced valuation models sourced directly from Tickar's institutional modeling platform, assuming a steady execution of the new business model, we see a clear mathematical pathway for SNDK to reach $3,100 by 2030. That represents a total return of 142% from current levels, or an annualized return of 25% internal rate of return per year. This is the power of compounding cash flows when a stock transitions from a low multiple cyclical commodity to a high multiple contracted AI utility. The runway is clear, the contracts are signed, and the upside is mathematically baked into the business model. So where does that leave us as we head into tonight's high-stakes earnings call? Our tactical thesis has been thoroughly validated by the market this week. The technical bottom was hit, the exit resistance zone was tested, and the squeeze played out exactly as we mapped out in our July 30th video. But our fundamental thesis is just beginning. Tonight is the ultimate test. Now, before we wrap up, an important reminder. This content is for educational and informational purposes only and does not constitute financial advice, a recommendation to buy or sell any security, or an offer of any kind. All investments carry risk, including the potential loss of your entire principal. Past performance does not guarantee future results. Always do your own research and consult with a licensed financial advisor before making any investment decisions. With that said, here is the bottom line. Sandisk is sitting at the intersection of a bulletproof balance sheet, a $42 billion contractual moat, a primed short squeeze, and two massive catalysts within the next 8 days. The valuation disconnect is extreme. Wall Street consensus is unanimously bullish, and the transition from cyclical commodity to contracted AI utility is accelerating. Whether tonight delivers a blowout beat or a temporary pullback, the long-term thesis remains rock solid. I want to hear from you. Drop a comment below and tell me, are you buying into tonight's earnings volatility, holding through to Investor Day on August 13th, or taking profits off the table right now, and why? Your reasoning matters, so be specific. If this breakdown helped you see SNDK in a completely new light, smash that like button, subscribe to the channel, and turn on notifications so you never miss another institutional-grade analysis.